Let's talk Chapter 4, Problems. I'm on the computational exercises. The first one I'm starting with is question 19. Before I get too far with those, just a reminder for everybody, there's always discussion questions at the back of the chapter. So there's questions 1 through 18, and the answers are posted over in my.usf. If you want to review those on your own, you're very welcome to do so. So I would just suggest, as a way to learn the material a little bit more, go through every single question and then look at the answers. So just FYI, that will help you a lot. So I'm going to work through pretty much all the computational exercises. Yeah, I'm going to work through them all here for Chapter 4. So starting with question 19. It says here, Marie and Ethan form a new corporation, Roundtree, with the transfer of the following. And so remember, this chapter, it's about kind of the steps you go through when you are taking personal property from your own assets, from another business assets, and you're contributing them into forming a new corporation. And the big picture that they use in this example, a lady starting a software company with a venture capital partner, and then potentially her employee maybe join her too. That's kind of the scenario. Just kind of keep that in the back of your mind. Hopefully you kind of read through that, gone through the PowerPoint, go over my discussion of that before we work on the problems. But that's kind of the framework I want you to have in the back of your mind as you work through these problems. So Marie and Ethan are forming the new corporation. Marie performs personal services for the corporation, fair market value of 80 in exchange for 400 shares of stock. Ethan contributes an installment note, basis 25, fair market value 30, land basis 50, fair market value 170, inventory basis 100, fair market value 120, and he receives 1,600 shares. Determine Marie's and Ethan's current income, gain or loss, and then calculate the basis that each takes in Roundtree stock. And that's what a lot of the questions are, and the exercises are kind of about that, with different potential scenarios about what people contribute. In this situation, Marie is contributing services. That's very okay. You are allowed to contribute services in exchange for stock of a newly formed corporation. Maybe somebody's got the knowledge, the know-how, they're willing to take on the work and the effort, and that's how they get stock back. Very okay. So, but when you do that, that's compensation. Okay, that's the key. Is Marie is working for the company in exchange for stock. That is now compensation for Marie, and that is basically compensation expense for the company. So just kind of think that through. And then I want you to note too, let's just do a quick sum of the fair market values of what Ethan is contributing. Okay, so kind of just make a note here. 30 plus 170 is 200, plus another 120 is 320. So 30 plus 170 plus 120 adds up to be 320,000 of fair market value of assets transferred into the business. Okay, and then keep that in mind also, that when you start a business, you start everything out at fair market value. You can all remember GAAP. And in GAAP, you buy an asset at whatever its cost is, which would be the fair market value the day you buy it, and then you depreciate it. And so your book value becomes some other number, right? And then things like land, a building, those typically go up in value. So it's not unusual that I would have land that I bought for $50,000 is now worth more than that fair market value. So when we start the new business, everything's contributed at fair market value. So I just want you to kind of keep that in mind too. Okay, so let's go back into Excel, and we'll just solve the problems over there. And so that amount realized basically is the fair market value of the assets transferred. So I'm going to type in the 320. That's kind of why I had you go over those numbers there. We just kind of looked at those. Now, also, before I get too far on this, remember the rules here. This is what they call Section 351 gains. And 351 means this is money that I'm transferring to a new business, and I can do this tax-free, so I'm avoiding capital gains, as long as what I contribute is at fair market value, and I do this after I do the contribution, I receive control of the company, more than 80% control. Okay, that's the key here. And they don't tell us any different, so we can assume that's what's going on. That we're contributing this and we're getting stock back, and one person gets 400 shares, the other gets 1,600 shares. So a grand total of 2,000 shares now. So two people now control and have more than 80%. That's called the Section 351 transaction. That's what we're kind of aiming for in this chapter. So Ethan contributes value of 320 on the items that he put into the business, and then we'll subtract from that their basis. So he had an installment note receivable, so that's the basis of 25. The basis of the land was 50. Basis of inventory was 100. Okay, so I can just summarize those, just sum those down, and that's the gain. Okay, so that's the gain realized. So there's a gain because we contributed basis of these three items of 175 in exchange for fair market value of 320. And so the gain recognized is the difference, which is 145. Now, gain realized is 145. I didn't say that right. Gain realized. That's not the same as gain recognized. Gain recognized is a grand total of nothing, 0. So I typed in a 0 right there, because that's what matters on the tax return. Is there's no gain recognized. Okay, it's not a taxable event. Essentially, Ethan's economic status has not changed. He just took assets that were either personal or in another business, transferred them to a new business. He still owns them. He can still use them. The new business will use them. So his economic status is unchanged. Therefore, this should not be a taxable event. Okay. So then the key is for Ethan, his basis is the 175. So his basis is the sum of the three things. So his basis in the company is 175. His realized gain is 145. Recognized gain is 0. And so the basis matters though, right? Because his fair market value is 320. His basis is 175. If he goes and sells this stock at some point in the future, whatever money he realizes will count against the basis of 175 to count against what his future capital gain will be if he sells the stock. Okay. Then for Marie, she receives ordinary income of $80,000, which is taxable. That's taxable income to her. And her basis is also $80,000. So her basis and income are the same. There's no gain to realize or recognize for Marie. Okay, so that was question 19. Let's go to question 20. Right here. Grady exchanges qualified property. Basis of 12,000, fair market value of 18 for 60% stock of ED Corp. The other 40% of the stock is owned by Pedro, who acquired it 5 years ago. Calculate Grady's current income, gain or loss, and the basis he takes on his shares of ED stock as a result of the transaction. Okay, so first things first is this does not qualify for the Section 351 for a couple of reasons. There's an 80% threshold. So Grady's putting in his property and receiving 60%. So right away he doesn't qualify. Also, this has to happen kind of immediately. There has to be a plan going into doing something like this. And the transfers should be, if various parties are doing a transfer, the transfer should be planned out, organized, and then you should get, control of 80% or more of the company right after you do that. Well, Pedro contributed 5 years ago. This is 5 years too late, okay? And we don't have the 80% rule. So this is not Section 351. That means that there will be a taxable event. So essentially, think of it like this. Basis of 12, fair market value of 18. Okay, so clearly then we have a realized gain of 6,000, and that realized gain is taxable. Okay, so it's just that simple. Realized gain of 40,000 which is then also recognized gain and is taxable. So Grady will pay a tax, a realized gain tax on $6,000. And then the amount he pays depends on what his tax bracket is, either 15% or 20%, depending on his bracket. Okay, that was 20. Let's look at 21. Jocelyn is contributing land, basis of 60, fair market value of 90, inventory with a basis of 5, and fair market value of 8 in exchange for 100% all of the stock of Zion Corp. The land is subject to a $15,000 mortgage. Determine Jocelyn's recognized gain or loss and the basis on the Zion stock received. Okay, so here's another common thing to happen is Jocelyn's contributing land, and let's see, the land is subject to the mortgage. Okay, and she wants to put this into a new corporation. And that's part of what, the big picture we looked at from the previous chapter, from chapter 3. It was somebody who owned a bakery, sole proprietorship, and realizing that if we put that into a C Corp, that person's tax bill may go down significantly because the C Corp tax rate is only 21%, whereas the highest individual tax rate is 37%. So that person, say, let's turn this into a C Corp. No different for Jocelyn. We don't know the whole reason she's doing it, but that could be a reason why. So she, has land currently, and that land has a mortgage on it. So I'm going to contribute the land to the new business, and guess what? The mortgage follows, right? So she now removes herself from the personal liability of the mortgage on the land, and the corporation assumes that. Okay, so now the corporation is responsible for the mortgage on the land. Okay, so that comes into play to determine her basis. Okay, so we'll go over to Excel, but I guess before we do that, let's kind of just remind ourselves what the numbers are. So land, fair market value 90, inventory fair market value of 8. Okay, so it's 98 clearly, right? Everybody sees that's 98. And then basis is 60 plus 5, which is 65. Okay, so 60 plus 5 for 65, 90 plus 8 for 98. So I'm going to just kind of do the same deal here. So I'm going to use the same format for the previous question for Jocelyn here. So what we're realizing now, I'm going to move this just one little piece here. Actually move it one more. So we're going to realize two different things for Jocelyn. I'm going to move that actually over here. And Jocelyn is, of course, we know that she is contributing property, and then also on top of that, she is getting release of the loan of $15,000. Okay, so I'm going to type in over here 98,000. This is 90 plus 8, the two fair market value pieces for the two assets that she contributed. Okay, and then she has basis. She doesn't have an installment note, but she has land. The basis was 60, and the basis of inventory was 5,000. Okay, so she's contributing 98,000 of fair value. So let's say FV for fair value, and then her basis was 65. Now, also keep in mind that she's got $15,000 worth of loan. Okay, loan release. And I should maybe just put that over here. Okay, and then she has the stock. So what I have to do is I have to take that 98,000 fair value, and I'm subtracting 15,000 of the loan release to get 83. So the sum of 83 plus 15 equals 98. Okay. Then what I'm going to do is take the sum of 98, the fair value, minus the basis, and we get a realized gain of 33. Okay, and of course, its recognized gain is 0 because this does qualify for Section 351. She immediately receives back 100% of the stock of the company. She has control. This qualifies. Okay. Now the final question is, what is her basis in the company? Okay. So her basis is the two items, the basis here of the land and the inventory. That's the starting point. However, we also have to go, well, she released the liability. She does not have to pay the mortgage liability anymore. Now the corporation does. So I have to take that into account. So her basis now is 50. Okay, so part of the question is, what's her basis? The basis is 50, the release of the liability. That matters if she goes and sells the stock. Okay, so if for some reason down the road she sells stock of the company, then that matters. Okay, so then she would have a she would compare the value received on that stock against her basis of 50. Okay, so that's why it matters. Okay, that was question 21. The next question is 22. Let me get to that one here. For 22, this is Diego. He's transferring real estate with a basis of 260, fair market value of 350, to a newly formed corporation in exchange for 100% of the stock. The corporation assumes a liability on the real estate of 300. What is his realized gain on the transfer of the basis of the stock? So immediately, what you should kind of realize here is he's upside down. Okay, and by upside down, what I mean is basis is 260, but he owes more than that as a mortgage on the property. It's his liability. Let's assume it's a mortgage. So he's got real estate worth 260, and he owes 300 on. So he's upside down on the property. Okay, that was not been the case before in previous examples given to us. So that's what's unique about this one. Okay, so basis of 260, fair market value of 350, liability of 300. Okay, those are kind of the big three numbers to consider. I'm going to erase all this, and we'll come back and kind of use the same format. Okay, so for Diego, this does qualify as Section 351, so there's no issue there because he immediately receives the control of the new corporation. Okay, but you know that relievement of liability is greater than the basis, and that's going to be the big issue for him. Okay, so I'm going to put in the fair value right here. That's the fair value of the property, which is 350. Okay, and then this was land, and the basis of his land was 260. Okay, and so the gain realized is simply the sum of all this. I'm just going to add those down. This inventory doesn't really apply, but I'm just going to leave it there. So his gain realized is 90. Okay, and that makes sense. Now, the loan release, remember, is 300. Okay, and the stock of the new company, I forget what the name of the company is, we'll just call it stock, okay, is going to be this. So I'm going to take 350 fair value minus the release. So we've got a 50,000 worth of stock then. Okay, down here I've got a realized gain of 90. The question then becomes, what's recognized? What's recognized is the loan release of 300 minus the basis of the land at 260. So this is my basis. Okay, so there's a gain to recognize. That's a taxable event now, of 40,000. Okay, taxable of 40,000. That's the key. So you can't just set up a corporation, transfer an upside down property to it, and be okay. You can do that, but it's going to kick in a gain, and then we're going to have to pay 40,000 long-term capital gain tax on that. We don't know what his percent. It's either 15 or 20, but he'll have to pay on that. Okay, so that was question 22. Let's go to 23. Yvonne and Simon form Ion Corp. Yvonne transfers equipment basis of 110, fair value of 165. Simon invests 130 of cash. They each receive 100 shares of the company, so 50-50, worth 130. But Yvonne also receives 35,000 in cash back from Ion. So in the chapter, they call that boot. Okay, so the same kind of deal here. What is the basis? What is the calculate Ion Corp's basis in the equipment, and then what is Yvonne and Simon's basis in the stock? So in the chapter, they call that boot. So if a partner contributes something to a new company, to a new C Corp, and then in exchange receives some cash back, that's just called boot. And that boot typically then is going to kick in something that's taxable. Okay, so just FYI. And you can see why they did that, right? So Yvonne's contributing something worth 165. Simon's contributing cash at 130. There's a $35,000 difference, right? So that makes sense she gets 35 back because the new corporation that they're going to start is they each get the same amount of shares, 100 shares each, worth 130. So it makes sense she gets 35 back. So it's not uncommon for that kind of thing to happen. Okay, so I'm going to get rid of these numbers here. We'll start out with some new numbers. So let's go ahead and put in the fair market value. This is of the equipment that Yvonne is kicking in. Okay, 165. Now, with this one, though, instead of loan release, I'm going to type in cash. So we know that 35,000 cash is going to come back. Okay, so that means the difference is 130. So 165 minus 30, we can all do the mental math there and go, it's 130. Okay, and this wasn't land, it's now equipment. So let's call it equip. And the basis on that was 110. Oops, let me hit subtract. Okay, and so the gain is pretty simple to calculate. 165 minus the 110 is 55. Okay, and then the realized gain is just simply the cash back. Yvonne got 35,000 cash back out of the business. That's a taxable event. Okay, so that's it. So she has to pay long-term capital gain tax on the 35,000 at the 15 or 20% rate. We don't know what that is. Her basis then on the stock, it's really simple to compute. Her basis is the 110. Okay, the basis of the property that she kicked in, plus the $35,000 gain, minus the $35,000 of cash received. So this is 110. Okay, the 35 gain and 35 cash offset. So her basis is just goes back to the basis of the equipment that she contributed, and it's 110. Simon's basis is really simple. It's just the cash. Simon contributed 130 of cash. That is Simon's basis. Okay, so that was that one. Let's go take a look then at 24. For 24, let's go back to the question. Got ahead of myself for a second. Chaz is starting a new business. He's going to transfer cash of 60 to a newly formed corporation for 100% of the stock. In the initial year, it has net income of 15. Net income is credited earnings and profits. The corporation distributes 5,000 to Chaz. Now, earnings and profits, we'll cover that more. I think it's in chapter 5. The next chapter that we talk about will be earnings and profits. That's coming up. That's basically tax code for retained earnings, kind of the same thing. So retained earnings and earnings and profit, essentially the same thing. Okay. So question A, how do Chaz and the corporation treat the distribution? Okay. Super simple. It's a dividend. Okay. It's simple as that. He forms a company, puts in $60,000 of cash. The new company starts, has income of 15. He gets a dividend out of that of 5,000, and he would then, of course, pay tax on the dividends at whatever his percent is, 15 or 20. Let's change it up. So now with B, assume instead that Chaz transfers to the corporation $30,000 for stock. and cash of $30,000 for a note of the same amount. So essentially, he's lending money to the business. So $30,000 cash and a $30,000 note. Okay. The notes payable in equal amounts of $3,000 each. At the beginning, at the end, the corporation's initial year of operations. The note pays interest of 6%. At the end of the year, the corporation pays an amount to meet the obligation, annual payments of $3,000 plus interest. Determine the total amount of payment and its tax treatment to Chaz and the corporation. So really just a little bit different, kind of semantics, but it's a different scenario now. So I'm going to scroll down to a new area. And so we're going to pay principal of $3,000. Okay, that's my principal. And then remember that the initial loan was $30,000. So up here I'm just going to type in 30,000 times 0.06. Okay, principal times interest. So every year, then we're going to pay $3,000 of interest back and an interest of $1,800. So that's my interest. Okay. So Chaz will receive $4,800. So the company will pay to Chaz $4,800. Okay. That $3,000 that Chaz receives is return of principal. That's not taxable. The $1,800 that he receives, though, is interest revenue and is taxable to Chaz. Okay, so that's just ordinary income to Chaz. He would pay whatever his normal tax rate is, anywhere in the 20s to 30s, whatever that rate is. We have no idea what that is, but that's what he would pay on that. For the corporation, that $1,800 then would be a deduction, and the $3,000 is just simply a principal payment. So by $1,800 deduction for the corporation, for Chaz, $1,800 worth of interest revenue. Okay, so that's what's different between A and B. A is a dividend, B is just interest. One more left, question 25. Several years ago, Min Jun, who was single, acquired Section 1244 stock in Blue Corporation at a cost of $60. He sells Blue stock for $5, so big old loss there, right? So cost of $60, sold it for $5. Determine the amount and nature of Min Jun's gain or loss recognized this year. So Section 1244, there's a few paragraphs in the chapter about that, and that's called small business stock. And there's a couple of special rules regarding small business stock. Okay, and so if you kind of think through the mental math here, Min Jun realized cash of $5,000. You subtract from that the basis of 60, you have a realized loss of 55,000. Right? Everybody can see that 5,000 minus 60 is 55,000. That realized loss, though, because this is what they call small business stock, up to 50,000 of that for a single individual, Min Jun single, or $100,000 if this was a married person, is given ordinary treatment. This is actually, it's a big loss, but the good news is that he can use 50,000 of that loss. So the loss is 55, but he can use 50,000 of it to offset ordinary income. And remember that ordinary income is at the highest tax rate. Whatever his tax bracket is, we don't know, but it could be up to 37. He can offset 50,000 of loss against ordinary income. So that's not a bad deal. So bad loss, yes, but he can do that. And then the rest of it would be treated as a $5,000 capital loss. So 50,000 against ordinary income, 5,000 against capital loss. So it's called small business stock, Section 1244. So just a little bit different rule for that. Just wanted you to be aware of that. That wraps up the problems. Big picture, as you work these problems, just kind of keep in the back of your head what's going on here. We have individuals who have personal assets or sole proprietorships or partnerships who are then forming C Corps. They're forming C Corps for tax purposes or for business purposes. And we want to realize that when they do that, all they're really doing is changing the business form. And generally, that's not a taxable event, unless these little rules that we just went over with all these different problems kick in, then that's a different story. So you want to make sure you understand what the Section 351 transfer is about. That's kind of the heart of the chapter, and that's what they walk you through a lot of when you go through, read through the chapters. So again, don't be afraid to read through the questions, the review questions, the back of the chapter, review those against the answers I gave you. That's just a good kind of a precursor to help you understand the concepts before you dive into the problems. And as always, if you have questions, just let me know.